Hey all, just wanted to pop in real quick. I just logged in this morning, getting ready to go on vacation, and uh, but I figured I'd log in to IB this morning so we'll see what's going on in the market. And I took a look at these Coinbase. I wrote up yesterday that I bought this small trade, like I bought a 5 lot of these straddles in Coinbase coin ticker on Wednesday. I in the post that I wrote yesterday, I talked about why I thought the vol was cheap. I thought basically it's about five. Feels like it's like 5 clicks cheap to me. So anyway, I just did a small position. I bought five. These at the time the stock was 193.82 in coin, and these 230 straddle, which is was the roughly the 50 delta straddle. It was really a four delta straddle. The 230 call was 52 delta. Remember the stock was 193.82. I think that sounds unintuitive to folks, that the stock price, that the 50 delta call is in this case $40 higher, or about 20% higher than the spot price. If that doesn't make sense, I've written that post, lessons from the 50 delta option, that kind of explains why that happens. But basically, it's because you have an option that's relatively long dated. These are December's, and it's a high vol stock. That vol back there is about 66%. So when you have a stock that has relatively high vol, a lot of time to expiration like that, the Black-Scholes distribution underlying the option pricing is going to look like a smushed log normal distribution, with like the median is kind of like pushed to the left, and it's got this long right tail. It's a positively skewed distribution. So when you have a distribution like that, the more a distribution looks smushed like that with a long right tail, the higher the 50 delta call strike is going to be. So in this case, it's $40. It was $40 out of the money. The other part of it is like the interest rates. I think that day I computed that the implied interest rate was just about 4.5%. That's the implied cost to carry, or interest rate in there. And so that means that the at the money, even though the stock's 193.82, the at the money was about $210. So you're at the money, stock 193.82 at the money call. Not at the money, at the forward. The at the forward call, I apologize. The at the forward call is the 210 call, and the 50 delta call is the 230 call. Anyway, like I said, I talked about the trade in the post, but I just kept it really simple. I said I'm just going to buy 50 delta straddles. So I bought the 230 straddle. I paid 97 and a quarter for it, which was about 60, just under 67 vol, like 66.9 vol. Mid market was about 66.5 vol, so a little bit of slippage there in the vol that I thought I was paying. But anyway, I was checking in on this thing this morning. Well, I actually looked at it yesterday, and the vol was down. The straddle the stock's been down for a couple of days, and the straddle was down like $1 yesterday, as vol had softened, had come in even more. So right now the vol is, so yesterday the straddle, like in mid market at one point like $96, maybe even slightly less. So I was like down like $1.25 on the straddle from where I bought it. But anyway, I kind of wanted to just point out today, just to show some dynamics about how the option market kind of works, or how the straddle works. So the stock is down now. The stock's trading 175.77 right now. Okay, so you can see my screen here. So I left the vol basically the same, 67%, which is really where it is in the market right now. Like our IB is telling me that mid market on those vols is 67%, and I left the other parameters unchanged. And on today's days, I'm computing a fair straddle price at 67%, with the stock now down here. Now the stock's dropped almost 10% since I bought these straddles, and just we want to make sure we always contextualize moves correctly. So a 9 point is what is almost 10%, 9.8% drop in the stock in the last 2 days. If you want to, a good thing to always do, I like to do, is turn all price changes into what vol that kind of implies. So if something moves, well, we know that if something moves 10% in one day, the way we annualize it is we multiply it, that move, by, we say, okay, a 10% move in one day is equivalent to like 160 vol move, right? Because we'd say a 10% move times the square, our shortcut is times the square root of 256, which is 16. That's how you annualize the vol, because 200 and roughly 250 something. There's really 251 trading days in a year, but we use 256 because it's easy to take the square root of that. So 10 times square root of 256, it's 10 times 16. That's 160 fall move. That's for one day, but this is a 2-day. This is a 2-day move. Technically, it's less than a 2-day move. Depends how much the Friday you think has elapsed. We're not going to get into that, but we're just going to say it's a 2-day move. Pretend it's the end of Friday. So from Wednesday to Friday, or from when I put really since like once I put the trade on. So I guess that was sort of like middle of the day on Wednesday to, middle of the day on Friday. Maybe that is 2 days. So 2 days, a 2-day move. So we're going to annualize by multiplying the move of 9.78%. And you can see what I did here. I multiplied it. I think you should see it up here. Yeah. So it's not times the square root of 251, but it's the square root of 251 divided by 2, because we did it over 2 days. It's a 2-day move, right? So that move was like a and by the way, this I have a price feed here, but it's 15 minutes delayed because it's coming from Microsoft. So in vol terms, over the last 2 days, it's been 104 vol move. We can think about it that way. And like I said, I bought 67 vol. Granted, I bought vol like in December. These options are a lot more driven by their vega than they are by their gamma, right? They don't have a lot of gamma. They don't have a lot of theta. And you can kind of see that here, right? Like the gammas, these are basically pretty small numbers. This is per one lot, by the way. These are small numbers, right? 0.004. And the straddle decay is 16 cents a day. But what I wanted to point out is, so I bought this thing for 97 and a quarter. Right now, this straddle, using my fair value, using my computations, using 67 vol, I'm getting a straddle value of 96.92. Repricing it on today's days with this stock price, and that vol. If you look in the market, straddle's actually trading like about $1.50 higher than what I'm running here. Why? Okay, that's a good question. I'm not 100% sure why, because IB is using the same vol pretty much I'm using here. So why all of a sudden is their straddle $1.50 marked $1.50 higher? And it's not really, it doesn't look like it's coming from an artifact to me of bid ask width and the call and the put. Remember, right now the 230 puts got a lot of intrinsic value, right? It's that puts over, is a 53 and a half dollars in the money right now. So a lot of this value here in this put is intrinsic, and so you would expect that maybe the 230 put market is really wide, and that's kind of screwing up what the mid market on the straddle looks like. But the market's actually not that wide right now, so I'm not 100%. I think it could be something to do. It could be something to do with. I'm using a European options pricing here, although that's how I priced this on Wednesday, also using this model. And as this put gets more in the money, maybe there's an aspect of on the margin, some early exercise premium would increase, and you would expect an American option at the same vol to have a higher, be worth more, to have a higher option premium. And IB is using an American style options model. I'm using a European style model, and maybe that impact is becoming a touch stronger as the stock is dropped here and this put gets more intrinsic. But I don't feel. I'm in general like, I'm a commodity guy. You don't have to worry about early exercises nearly as much as you do in equities, but I don't think that impact's going to be all that large. So the other weird thing is like it does if you throw a 3% rate in here. Remember, if I lower the implied rate or I lower the option pricing rate here that we use, most of this straddle value is coming from the put. If you lower the rate, put values go up relative to call values, right? This kind of goes back to understanding your put call parity and how cost to carry on strikes works. But if I lower the rate, the put will go up relatively. If I do that, you can see the put shot up. And they'll basically, the rate will affect the option sort of like by their deltas, really. And the put's going to be more affected than the call. Actually, probably not by its deltas. The deltas are not that far apart. But this pricing here, it affects the cost to carry on this more. And so you're seeing that the straddle value now went to 98.14, right? So it's shot up, and that's about the difference between my model and the IB model. So, you're getting 98.14 with a 3% rate, 96.92 with the 4.45% rate that I used to price it the other day. Now, look, I don't think anybody is speculating on rates using Coinbase. By the way, they're setting Coinbase option services. So, I'm pretty hesitant to think this has anything to do with like any real, change in the rate move. And obviously, the rates are down in the market. Like right now, bonds are up, rates are down. But if the rates was down 150 basis points in a 9-month term, that would be Armageddon. So that's definitely not what's going on here. So I'm not 100% sure why we're getting why this model was kind of in line on Wednesday with the IB model, and now it seems to be a lot wider, a lot more decoupled from it. Why we're getting $1.50 difference. But in any case, I don't want to dwell on that too much more. But we just want to talk about when I put that straddle on. That call was 52 delta, so that's a 4 delta straddle, right? The call is 52 delta, the put's 48 delta. So when I bought that straddle, it's like I got long 4 deltas, right? It's really, really small, which is which is like 20, like less than 20 shares, or on a 5 lot, it's like 20 shares equivalent of coin. But right now, what happened is the vol is basically unchanged, and the straddles went up in value, at least on IB. I have it like not pretty close to unchanged ish using this model. But if you look here, look at the delta of the straddle now. Now it's actually flipped. There's been a lot of gamma impact here. The straddle is now a 10 delta straddle to the put, right? The put is now the 55 delta option instead of being a 48 delta option. And the call is a 45 delta option. So the stocks dropped 9. It looks like it's been rallying a little bit, but stocks dropped 9% since I bought these straddles. So I could go out there and gamma hedge this, right? Like I could go buy 10 deltas worth of stock, right? Which is, like I said, this was a 5 lot, so 10 deltas worth of stock is 50 shares, like pretty small. But you can see like here, there's really, you could think about it as like if the strike vol is basically unchanged, the 2-day P&L in theory is the vol P&L is basically zero. There's no vega P&L to this. There is going to be gamma P&L, or you can think of the realized P&L as there's some gamma P&L in there because the stock price has moved, and we can compute like a gamma P&L, and then the theta P&L would be losing 16. Well, you're losing like 16 cents a day on these things. So overall, I didn't compute the gamma P&L, but the gamma P&L is, I'm up. IB says like to mid market, I'm up money on these things now. So the gamma P&L has outweighed both the negative, the initial delta P&L, which I was long. It's outweighed the theta P&L and the Vega P&L should have no impact. So the vol hasn't changed, but you're kind of making theoretical money here. I mean, you are making real money if I could sell the straddle mid market, right? I've made money on the trade, but but the point is it's coming from the gamma P&L outweighing the theta P&L on these things, and that makes perfect sense. If you buy 66 vol or 67 vol and you have a 101 vol move over the next 2 days, like you're going to have positive gamma P&L. So, if you had bought 67 vol on a near dated option and you had a 101 vol move over 2 days, you'd make a lot of money because you would have a lot of gamma, right? You'd have a lot of gamma. So your dollar gamma would be really, really high, and your option exposure, your option P&L would have very little dependency on your Vega P&L, because your Vega is probably pretty small on the short dated option. But your gamma and theta P&Ls are the largest drivers of your results. So, when you're long or short near dated options, you care a lot about what option vol did I buy or sell versus what happened here. Like, what is this thing? Like, what is the move that we experienced in vol terms? This effect is going to be more muted because we had a 101 vol move over 2 days, but in my case, I got an option with 266 days of maturity to it, so it's just 2 days. So it's a little bit of P&L due to gamma and theta every day. The bulk of the P&L would come from how vol changes, and then over time, as this option becomes more and more near dated, it will switch from being it will gradually go through this glide path of being like, oh, this trade is less about Vega and it's more about gamma and theta. That will kind of happen over time. But in any case, looks like Coinbase is rallying a little bit today. I didn't buy any deltas against this. And I didn't have any intention of delta hedging this on like a daily basis or anything like that. I'm kind of comfortable with, it's $50,000 of option premium. Like, I'm comfortable just it's not that much risk. So we'll let it kind of ride. And that said, I wouldn't, I think if the stock kept dropping a little bit further, I might have bought some shares. I might even just for fun buy some shares. I could buy like 10 shares or whatever, and then revisit this after vacation, see where the stock is, or if I log in and notice the stock is up a whole bunch, I could go flip the 10 shares and kind of, it'll be a little demonstration of like how this gamma P&L actually kind of works in real life. But anyway, just wanted to share that. I'm going to be going on vacation. Actually, I'm headed to Texas today. I'm going to visit friends in Dallas. My family's going, and my in-laws are coming with us too. It's like my wife's sister's family, so it's like going to be a big little boondoggle down there. And then after that, I'm actually going to go to Austin for a couple days, and I'm actually putting my kids in the Alpha School to shadow for a day. I don't know if that's like a school that's kind of been in the news and stuff like that, but I've got a really good friend that is working with that team over there. He used to live here in California near me, and he moved a couple months back. And he's doing and he's working with that team over there, and he's been bugging me to like come down there and like let my kids hang out there for a day. So I'm gonna put my kids in Alpha School and hopefully maybe see a couple people down in Austin. And anyway, that's spring break for us. Spring break means I'm putting my kids in school for another day. That's they're kind of giving me a hard time about that, but it is what it is. Anyway, and enjoy your weekend, and thanks for checking us out.